What is happening, investors? It is your boy Jack, and today we're going to be speaking about 5 stocks that have immense growth potential. All of the stocks that we speak about today have been hit particularly hard because of the virus that's going on right now, and may be giving us a great opportunity to get into them. These are the kind of stocks that a lot of people perceive to be higher risk, but with higher risk ultimately comes higher reward. And I know on the channel we always like speaking about these higher risk, high potential stocks, so why not get a few of them out there in one video. I want to thank you all so much for helping me hit 1500 subs. If you're not a part of this little family we have going on, hit that red button right now. If you enjoy the video, feel free to tap that like button as well. But anyway guys, make sure to watch to the end so that you can get my full opinion on every single one of these stocks, and at the end of the video let me know what you guys think about these stocks, or if there's any other ones that are on your watch list that you might get in or you're already in. Now let's get straight into it. So we're starting it off with the one, the only Carnival Cruise Corp. Carnival is one that I'm pretty sure every single one of you watching this video will know. I've spoke about them a lot. There's a lot of hype around them on YouTube at the moment. Everybody's speaking about these guys. With Carnival, we've had a 52-week high of $56.04 and a 52-week low of $7.8. So we have seen absolutely massive losses with Carnival. And we can see from that $7.8, we've come back up to 12.15. So it has been a very strong climb, but we're still down over 75% in the last 3 months alone. So they've been hit a lot harder than the average company. And this is for very obvious reasons. Carnival is obviously a cruise line, you know what I mean? Cruises aren't allowed to sail right now legally, and we don't know when they will be allowed to sail again. And the reason I personally like Carnival more than its 2 biggest competitors, Royal Caribbean or Norwegian, is simply because they are the biggest in the whole game. They carry just about 47% of all passengers in the cruise line industry and have about 40% of the revenue from the entire industry. They're massive player. They're pretty much twice as big as their main competitor, Royal Caribbean, and 5 times as big as Norwegian. So they're the biggest out there by an absolute mile. Now, Carnival wasn't eligible for any of the stimulus money, you know what I mean? So they weren't getting bailed out by the government in any way, shape or form. So they did have to go and take on their own new debt. And we can see here, Carnival pays steep rates for nearly $6 billion in new debt. And steep rates is no exaggeration. They took on $4 billion of senior secured notes with a coupon of 11.5% interest. So massive. Carnival are desperate, but they have to be desperate. You know what I mean? They're not making any money, and they still obviously have massive expenses, although they have done an awful lot to lower those expenses. A few quick things to note in regards to their financial situation right now and going forwards. They reported a GAAP net loss of $781 million or $1.14 per share on revenues of $4.8 billion for its first quarter, compared to net income of $336 million or $0.48 per share on revenues of $4.7 billion for the same quarter last year. So obviously a terrible quarter. It was expected. One promising thing though, Carnival stated for the first half of 2021, booking volumes since its last conference call in mid-December have been running slightly higher than the prior year. So people who want to go on their cruises still want to go on their cruises, and even more people are booking cruises. And today we're looking at companies who we think, you know, can give us back 100, 200, 300% in a matter of a few years. If Carnival survives, the demand is quite clearly still there. It is clear to see their bookings are actually higher than this time last year for next year. Now obviously part of this will be because people are going to be, you know, deferring their current bookings to next year, but still it is very promising. I've said in previous videos I more than likely won't invest in Carnival unless I see it get to $6 or $7 a share. My outlook is slowly changing as more and more good news comes out. Even things as simple as prices of oil coming lower brings Carnival expenses down, gives their chances of survivability higher. It's all promising, and the fact that we can see that demand for cruises is still there, again, it's very promising. So I may have to reevaluate my entry point. Out of all the stocks we speak about today, this is the one that personally I am the most interested in. With the fact they've taken on this new debt, Carnival can more than likely survive at very least 8 to 10 months with absolutely zero income. That means they could get to the end of this year and even into next year with zero income whatsoever and still survive. So as long as they're bringing in money before then, Carnival should be absolutely fine in regards to, you know, not having to go bankrupt. Obviously anything can happen, and these are just my thoughts and expectations. I'm not a financial advisor, but yeah, I like the look of them, and I'm getting more and more confident in them as time goes on. Anyway, stock number 2. We are looking at Delta Airlines, a company I do actually own a position in. I will show you that right now so that you can see that. Obviously not the best performing position in the world, but I'm still very happy to be a part of this company, and even happier since I looked through their Q1 report. I made a full video on these guys yesterday, so if you want more information on Delta in particular, make sure to check that video out after this one. We've had a 52-week high of 63.44 and a 52-week low of 19.10, and we're currently sitting at pretty much $22.50 a share. So we see here a 3-month change of negative 62.7%. Obviously very poor, but they're the stocks we're looking for today. We want the stocks who have been hit really hard, who have this massive potential. And similarly to Carnival, in regards to airlines, Delta is the big boy, right? The most revenue, the most profit, the most assets, the biggest market cap. Not the most employees. Who cares about the employees? They're the biggest. In regards to passengers carried, they're a little bit behind American Airlines, but who cares when they're making the most money and the most profit? And unlike Carnival, Delta actually are getting some sort of a bailout from the government, which is fantastic for us investors. Again, I made a whole video on these guys yesterday, but things are looking fantastic for Delta. They didn't have to go and get any really high interest debt. They got given an awful lot of it from the government. They've cut their expenses by over 50% starting from sometime next month. They've had a lot of employees go on voluntary leave. They're storing their aircrafts in the most efficient way. They're doing an awful lot to stay afloat, and they are doing a great job, and my confidence in Delta is only going up, and this is one that I definitely plan on buying more shares in. These are a company that I would be in no way surprised if within 2 years we saw close to 200% growth. I could see those highs being met and smashed, because until this happened, we have seen really consistent long-term growth from Delta. Obviously, it's very cyclical. The airline industry is always going to be very cyclical, but it's been up, it's been down. New highs, down a little bit, new highs, down, new highs, and then boom, massive crash, down 50% in the 5-year. I think this is an absolutely amazing opportunity. This is an extract from the transcript of the Q1 earnings call, okay, and this is from the CEO themselves, and he says, our response has been focused on 3 priorities. First, protecting the health and safety of our employees and customers. Very obvious. That is what has to be done. Absolutely. Second, preserving our financial liquidity to work through the crisis. Obviously, that's what we need to do. They need to be able to survive while they're making far less money. Their passenger load is at about 5% of what it normally is, so obviously a whole lot less money. And third, ensuring we're well positioned to recover once the virus is contained, and building a plan to accelerate our progress through this period of recovery. So not only are they doing everything they can to possibly survive, but they're getting a plan put in place so that once all of this is over, boom, they're straight back to growing, they're straight back to being profitable, they're straight back to being the best at what they do. I used to think that Delta was a high risk play. I really did, and I said that in previous videos. Now, I honestly don't. Obviously, there is still a chance that even Delta, anybody could go bankrupt. But to me, these are not a high risk play anymore. These to me are a safe play, which is very shocking to say, but I will definitely be buying these guys more aggressively. I might even buy some today. I haven't bought a single stock this week. Delta might be the one stock that I buy this week. That was Delta. You could throw other airlines in there, you know, the big players, American Airlines, Southwest. A lot of them have similar situations going on, but Delta is by far my favorite. Number 3, we're now looking at Disney, and I know there's a lot of mixed opinions on Disney, but I love them. I've spoken about them a few times in the past. I really like Disney. They're actually my biggest position right now. I'll show you that on the screen right here. But looking at them, okay, 52-week high, $153. 52-week low, $79. So, you know, very close to a 50% drop for a company that's as big as Disney. This is not a small company. This is one who's been around for decades and decades and decades. They've been around forever. Mickey Mouse, man, when he started off, he was in black and white. These guys are massive. We're currently down just shy of 30%. You know, we're at 29% down right now, just over $100, very close to $101 a share. Now, I will say I don't see this one bringing you 200, 300% return in a matter of months, but from a long-term investor's point of view, I definitely see massive returns. And what's nice about Disney, as opposed to the last companies we've spoken about, they are still paying a dividend now. So be it, it's only 1.74%, and it might not be the safest in the world. In my opinion though, they're growing it for 27 plus years. I think that they will keep paying it. They have enough money to do so. There's no chance of bankruptcy. I don't see why they would cut this dividend. And that's what's also nice about these guys, is you don't have to worry about your stock turning to absolutely zero. In my opinion anyway. Obviously some people will say there is a chance of them going bankrupt. I don't see that happening. We just have a look at their max stock chart now. You can see we're at levels that we were at about 5 or so years ago, you know, so not crazy. It's not like certain stocks are back to, you know, levels from 20, 30 years ago. 5 years ago, it's still offering, in my opinion, an amazing opportunity to get in. They're a company who's consistently made over $10 billion in profit, not revenue, in profit for the last 5-6 years. Current assets at $27.7 billion, but total assets at just over $200 billion. It's not often you see a number that big. Compared to our liabilities, current liabilities 34.7 billion, obviously a little bit more than the current assets, but they'll be able to manage that, no problem whatsoever, and total liabilities of 97 billion. Their cash sheet is good, they're in an absolutely fine position, and these guys are still making money. Obviously the parks are closed, you know, that's a massive source of income for these guys, but the launch of Disney Plus could not have come at a better time, and it's been incredibly successful. When parks start to open back up, when sports are back on and people are watching ESPN, when Disney's cruise lines are going again, Disney Plus is still going to be going, and in my opinion it's more than likely still going to be booming. All of that is going to come together, and they're going to pick up right where they left off and get straight back to growing. And despite a lot of things looking quite poor for Disney, their total sales has gone up and up and up every single year for the last 10 years, including last year. And obviously this year is going to be a little bit shaky, but it says very good things for future prospects. So that was Disney. Let's get into number 4. Now we're having a look at Wynn Resorts, okay? And quickly, let's just have a look at this. 52-week high, $153. So massive stock price. 52-week low, $35.84. So a massive dip. So in case you guys don't know who these are, they're in casinos and gaming, and they have hotels. That is what they do. So they operate 424,000 square feet of casino space with 323 table games, 1,000 slot machines, private gambling salons, Sky Casinos, a luxury hotel with 1,700 guest rooms, suites and villas, including a health club, spa, blah blah blah. We all know what a hotel is, but that is what these guys do. Now these guys are in Vegas, and Vegas is on lockdown right now. It must be crazy for the people who live there. I've seen pictures. We all know what Vegas normally looks like. It's dead. Now a lot of you guys are probably looking at that dividend yield and saying, that looks very nice. I wouldn't keep my hopes up about them continuing to pay it, because look at this. Uninterrupted dividend streak 4 years, dividend growth streak of 2 years. It's been all over the place. Obviously, as soon as times got really good after the Great Depression, they started paying it, which is lovely to see. They could well have to temporarily cut it off. We'll have to wait and see. Who knows? But if they do keep paying that dividend, that's going to be absolutely incredible. It's going to be amazing, because we're not investing in this company for their dividend. It is entirely for the growth potential. These guys have actually had a massive rebound. They were as low as $43 a share, all the way back up to $76 a share. You know what I mean? There's been that massive rebound, but they are still down 45%. And this is another company where I don't think a lot of people would be surprised if they were to get back up to their highs within 2 years, which is showing us pretty much 100% growth. One thing that has me relatively tentative about this company, and one of the main reasons I haven't actually bought them yet, well, one is I haven't done my full research. I haven't looked at all of their quarterly earnings, their Q10s, things along those lines. But their other one is, if I just go have a look at their max stock chart, they seem to be very cyclical. I mean, we see immense growth. Such a fast drop. Now, this was the Great Depression in fairness, and since then, there was an awful lot of growth until this happened, and we were at $250 a share, and it fell all the way down to about 60, 50 even. Crazy. Again, we see massive growth, you know, hundreds and hundreds percent worth of growth, but then again, massive dip, and then it was in a bit of a stagnant place, and then boom, this dip happens. So if I am to buy this company, one thing I'm going to have to keep in mind is I'm going to have to keep a very close eye on them. The first 3 stocks I spoke about today are 3 that I definitely want to get involved in. I'm in 2 of them already. I'm just waiting to get into Carnival. Wynn is probably the riskiest of them all, but maybe that's just because I haven't done enough research. I know a lot of people really love and believe in these guys, and I really do see the appeal. When this is all over and done with, man, people are going to want to have fun. Those guys in Vegas are going to be dying to go back to the casinos. They're probably going to spend more money than they ever have. And I think we could see something similar to here, like a massive spike. But my fear with these guys is always going to be that it's followed by that massive drop. But if you do want that high risk, high reward play, definitely worth keeping these guys in mind. And then the last company I want to have a look at is JP Morgan. So JP Morgan are a banking company. And you can see they do all of the things that banks do: consumer and community banking, corporate and investment banking, asset and wealth management, and commercial banking. Now, I'm not in these guys yet, and I actually am in Wells Fargo, but I think I got into Wells Fargo far too early. That was one of the first stocks that I bought. I didn't do proper investment. I was a complete and utter noob in the market. I suppose I still am, but I know more now than I did then. And after doing some reevaluations, I prefer the look of JP Morgan. But it's a lesson learned. I'm not upset about it. I'm not going to sell them for the sake of it. I'll keep an eye on them and I'll see what happens. But now we're talking about JP Morgan. And again, we see a 52-week high of $141, a 52-week low of $76. So absolutely massive growth. And now they're trading back up at $89. So we haven't seen the absolute biggest recovery like we have seen with some companies. We saw with Wynn and Carnival pretty much 50% gains, if not more. These guys, we haven't seen that. And somewhat similar to Disney, I don't see these as being somebody who will give you 200% return, but I do definitely see the potential for some massive upside in the short term. What I do really like about these guys, especially for a bank, if you look at an awful lot of the banks, they're very cyclical. They have messy max timeline stock charts. JP Morgan has a very nice one in fairness, you know, it's not like it doesn't come without its downs, but in the long term, there does always seem to be this nice bit of growth. Now, I know it's been an amazing pretty much, you know, close to 10 years, 7 or 8 years, and now we're seeing this massive dip. Everybody's seeing this massive dip. But I always have more confidence in a company when I see the stock chart that backs up their fundamentals. Now quickly, I do want to touch on Wells Fargo as well, because today is about the ones that could potentially give the biggest returns, and in fairness, Wells Fargo is still down an awful lot lower. They're nearly at their 52-week low, you know what I mean? They're nearly there. They've barely recovered whatsoever. So these guys may have the most potential, but they come with a lot more risk in my opinion than JP Morgan. That's why I plan on investing money into JP and not necessarily increasing my position with Wells Fargo. Potentially one reason that Wells Fargo hasn't rebounded as fast as a lot of the other people, they had to pay $3 billion over fake account scandals. Since the fraud became public, this was all the way back in 2016, the bank has faced a torrent of lawsuits. And this is one of the things that I overlooked when I went into buying this company. I did not do proper research. I'll put my hands up and say that, man. You know, this was literally within my first 1 to 2 weeks of investing. I didn't do proper research. But I learned an awful lot from buying this stock. I now know to always do more research, baby. But that's why I prefer JP Morgan here. Again, probably the least exciting of any of the stocks we spoke about today, but still absolutely massive upside potential. Boom, there we are, guys. 5 stocks that could be giving us an opportunity for absolutely massive returns. If I had to put them in order, I like Delta the most out of any of these guys in regards to, you know, their risk to reward ratio. Secondly would come Carnival. You know, a few weeks ago, Carnival would have been right down at the bottom because the chance of bankruptcy seemed so high, but now I really do like them. Next up comes Disney, because the risk is very low and the reward potential is still really high. Then I would have to put JP Morgan. The reward is not as high potentially as the other ones, but the risk is also quite low. And then Wynn Resorts, partially because I haven't done enough research into them, I'll always put my hands up and be honest, but partially just because they look really scary. I mean, their max stock charts is one of the most cyclical I've ever seen in my life, and that is a little bit scary, man. It'd be the kind of company where if I got into them and I saw them go up 60-70%, I'd be having to ask myself the question, do I need to sell these guys now? Is the next big downfall coming? And that's not what I like doing. I like just buying my companies and hopefully holding on to them forever. I don't like having to think about it too much. Hopefully you guys did enjoy that video. If you did, please make sure to smash that like button. If you haven't, drop me a comment with your thoughts on any of the stocks we covered today, and make sure you hit that juicy red button. Join the squad. Right, until the next one, guys, peace.